Welcome to this week's live ASX strategy session. Thanks for joining me. Great having you with me for the show. A whole lot of stuff to talk about this week with the stock markets, the commodity markets in particular, a lot going on there. So plenty of interesting things to go through. Then, of course, your stock codes at the end of or the second half of the show. We're going to go through any stocks you have an interest in. So get them ready, get the codes ready. We'll go through them a little bit later. Now, as always, everything today, general commentary only, doesn't take your personal situation into account. Having been through all of that, let's get into this week's first chart. And starting off with the ASX 200. And, well, ASX 200, it's starting to break down, starting to break below some support. Is this the start of a larger correction? I'll talk more about this in a moment. Then over in the US, the NASDAQ is breaking lower as well. But it's also happening while the number of stocks generally are increasing. So which is right? What should you consider doing now? I'll come back to this shortly. But before we get to that, let's start with this latest price action in the ASX 200. Last week we talked about the possibility of consolidation below the January high. And well, so far that's been playing out. We've seen a rally off the moving averages, and then we've seen and then from there we've seen a pullback to below or to the moving averages, and now just below the moving averages. So that's your classic back and forth price action that happens when a market pauses. So what should we be looking for now? I think the key to a near-term bullish outlook is for prices to hold and become established above these moving averages. We have a situation where prices have rallied. If we go back to the November low, prices have rallied from below the moving averages to above the moving averages. And when prices were below the averages, they were there was some vulnerability present below the averages. But that didn't lead to follow through selling, and instead we got the rally back above the moving averages. So when that happens, that passes a baton back over to the bulls, and it's what happens around these moving averages that I think sets the tone for the next move, or at least for maybe the next few months. If this weakness we're seeing on Friday, if this is contained, if this doesn't get much further than where it currently is, if the market can get a foothold here, just get itself back above the moving averages, and then we do get that base around the moving averages, well, then that potentially sets the market up for a run up the October all-time high. But what if prices where they are now? What if prices continue to slip below these moving averages? I think this is a real possibility to consider, especially with what's happening in the US, which we'll discuss in a moment. I think if prices can't hold here, and if they do start to slide below the averages, it'll be a sign that the market just lacks sustainable momentum in either direction. It couldn't sell off in November when it was vulnerable, and when it's back above the moving averages, if it can't hold here and starts to slide, it's telling you it just doesn't have that power in either direction, and that is probably not ready to continue the uptrend we had during 2025. And should that happen, I think that would open the possibility of maybe a trading range developing. So if we use the October high and we use the November low as key points, something like this could develop. Let me just draw something up. So say we got a situation where prices pull back for several weeks, find support, they rally a bit, and they have a bit of sideways consolidation, and then from there maybe start to move higher mid-year. So I think some sort of price action like such could be worth considering. If prices can't hold around their moving averages now, then I think the range scenario comes into play. So this isn't all about telling you where the market's going to go, because of course I don't know. It's about getting you thinking about possibilities. So I'm sure there'll be lots of doom and gloom about the market's going to crash, as there always is. Some are always saying the market's going to go up, but all sorts of things can happen. Also consider, do we get a range developing? I think the range is a bullish scenario that could mean a slow first half of the year and then potentially a rally later in the year. And when you compress the price action, you have a look. It's like we've seen these ranges before. Like that's very much a sort of thing that could develop. Maybe it doesn't. Maybe something completely different happens. But it's something to keep in mind that this sort of price action could develop. I think the upshot of all this is that we don't know where the market's going to go, but I want to stay long stocks. But I'm a little cautious on the timing, and I'm thinking about how this could play out. Hence, do we get that range? Another factor that could favour the range is what's happening in the materials sector. So let me show you. Let's jump over to materials. So this is the ASX 200 materials index, and so this has had a big run over the last 6 or 7 months. Strong run, rising moving averages, all of that, all bullish. That's all good. But the thing is that it really had become stretched. It become stretched above its moving averages, and when a market gets stretched, well, as we know, it often pulls back towards the averages, which is very much what's going on now. And with the ASX, with the materials pulling back. It really, I think it makes it hard for the ASX 200 to move higher at this point in time. It's probably going to be a break for the ASX 200. And the big reason for that is that financials are not really participating at the moment. So coming over to the financials index, so this is the ASX 200 financials. We've talked a bit about this in recent times. Financials are doing a bit better. Prices are now back above their moving averages, but they still need to become established above the averages. The averages still need to turn higher. There's a bit more to do. I don't think financials are ready to take the lead and push the overall market higher. I think it's a positive that this downward dynamic that was potentially developing. I think it's positive that momentum's been cut, but I think it still needs time to turn itself around. So that, I think that also plays into that ranging scenario. Maybe the ASX 200 overall just isn't going to be going a great deal in either direction in the over the next few months. Lastly, the equal weight. Let's have a quick look at the equal weight. Now, this has been a quick and a sharp reversal. Prices giving back all of January's gains. And some. So it's back to near where it was in mid-November. This is something we often talk about with individual stocks, where prices rally quickly and then give back most of their gains. And when we see that in an individual stock, it's a sign the dip isn't being bought. And this is different price action to what we've been seeing previously or in recent times in the equal weight, where you can see these strong rallies and then these really relatively shallow dips, which were quickly bought, pushing prices higher. Even in recent times, the shallow dip, not what we're seeing now. This is a quick and sharp reversal, raising all the gains from the previous couple of months. So buyers aren't coming in quickly to soak up supply. Instead, there's just outright selling. The pullback doesn't end the uptrend, but I think it points to it being on hold for now, and then more consolidation being the likely course in the weeks ahead. Like that, from that April low, that's still an upward trend. Upward trends have volatility. It still meets the criteria for an uptrend, but with that consolidation and correction now. I think that now's a time. I think now's a time to give winning positions plenty of room to move, with the aim of seeing off further consolidation, but at the same time, being ready to sell what's no longer working. And I think we can be patient with new buying for now. Let's see how this price action develops over the coming weeks. Let's see what the next rebound looks like. I think there's time for waiting and watching, and of course following your plan. And now we're going to move on to the US stocks now, the US market. But first of all, if you're liking this, if you're getting some value, please click that like button. Tell me what you think. Leave a comment in the section below. Do you think this is the start of a big downturn, or is this just something which is temporary and will pass in the weeks and months ahead? But yeah, definitely please click that like button. Helps me heaps. YouTube shows other people because it sees people are watching and engaging. So that helps me a lot. Please do that. Click that like button now. All right, S&P 500 over to the US markets. Now, are there cracks? Are there cracks appearing in the US market? Prices dipped below the January low. So there's the January low. So prices dipped below the January low on Thursday, and they look set to test the 100-day moving average on Friday. I'll come back to the S&P 500 and talk a bit more about this in a moment. But first, let's go over to the NASDAQ. Let's really start with the NASDAQ today. And this has been one of the weakest segments in the US market, and that's been the case for several months. So while there's been strength across other sections of the market, tech, and in particular big tech, has really been the drag, and you can see that in the price action we're getting in the NASDAQ. Looking at this latest price action, the NASDAQ has broken below the January and the December lows, and it's also had consecutive closes. So you can see the close for the last couple of days. It's had consecutive closes below the 100-day moving average, and that's the first time that's happened since back down here in April. So does this signal a trend change? And the answer to that is no, it doesn't. It doesn't signal a change. Uptrends pause. They can dip below the moving averages. Like just for instance, like just look at the during 2024. You can see there are periods where price can come below the 100-day moving average. And then relatively briefly, it's not like we want to see it below the average for several months. That changes the structure. But relative brief excursions below the 100-day average do happen, and the trend can resume. So just being below the average on itself isn't a trend ender. At this point in time, there's not enough here to point to a trend change. For that, I'd want to see a change in that underlying structure, which we don't have yet. For instance, if we go back to just over to 2022, this is where the structure changed from rising lows, rising highs to lower lows, lower highs. Moving averages switched to the downside. Price was consolidating below moving averages, and then downward momentum continued to build. The structure changed. We don't have that structural change at the moment. It's like we're here. We're below moving averages, which are generally still rising. So it's not a trend change at this time. It's not to say it can't develop, but but look, it just has not happened yet. I'd also want to see to turn bearish on this market. I'd also want to see worrying signs in other indices, but other segments of the market, as I said earlier, other parts of the market still look strong. I'll show you what I mean. Let's jump across to the Dow. So have a look at the Dow Jones Industrial Average, and look, this is still a textbook upward trend. Rising moving averages, the 50 and the 100-day moving averages continue to rise. There's also a long-running series of rising lows and rising highs. And if you just look at the most recent price action, it's a tight consolidation above the moving averages. And more often than not in an upward trend, these tight consolidations above moving averages resolve to the upside. So the Dow isn't giving warning signs that a major turning point is approaching. That's not to say a top can't form, but it's not the conditions we currently have. If we come over to let's have a look at the equal weight. So this is the the S&P 500 on an equal weight basis. And so this is also another important part of the picture. It had its highest closing level ever, so a record closing level on Wednesday, and all-time highs. Well, all-time highs aren't a bearish signal. In fact, all-time highs often lead to more all-time highs. And just like the Dow, the equal weight, it's got the rising moving averages, and prices above those averages. It's a similar story in the small caps, which I'll cover a bit later. So we have this situation where participation in the uptrend is expanding. We can see that through the equal weight. To push equal weight high, you need broad participation. So participation in the uptrend is expanding, but the Nasdaq isn't performing, and in fact is showing signs of extra weakness. So I think this really muddies the waters. So just coming back to the Nasdaq, and is it simply a case of rotation out of tech, or is the divergence between tech and the rest of the market a warning sign? And no one has the answer to that. Lots of people have an opinion on that, but no one actually knows for sure. I think it's a situation we need to be aware of and a situation we need to manage. I don't think we should ignore this ongoing weakness in the Nasdaq, and I think there's enough here for some near-term caution. So caution is different from turning bearish and wanting to run out and sell everything, but near-term caution. Just looking at the recent volatility in commodities, in say Bitcoin, if risk-off sentiment were to spread, then maybe equities could pull back. Maybe we could see more of this Nasdaq-like price action in under indices. But as I say, we don't have a bearish signal as such. Just got some points of maybe orange flags just to consider and manage our risk around. Over to the S&P 500, just coming back to this, the overall upward trend is in place, and rising moving averages, trends in place, but the potential for a pullback certainly does exist. I actually sold half of my S&P 500 exposure on Thursday. I had an ASX listed S&P 500 exposure. Two reasons for doing that. So one was just to reduce risk a touch, given what I've just been through. But the other was due to strength in the Aussie dollar. I'll get to the Aussie dollar in the second half of the show. But with the Aussie dollar rising, well, it reduces performance of US dollar denominated holdings. So I'll look to reinvest in the S&P 500, maybe with a hedged S&P 500 ETF a little bit later. And I think this current lack of momentum, this current pullback, I think that and the potential of a further pullback, I think it just opens that possibility for me to switch from a US denominated S&P 500 to a hedged version. I think we can be patient with buying this week. I want to see signs of the dip in tech being bought, and I want to see signs of prices getting back above these moving averages, particularly in the Nasdaq, and always having that exit strategy in mind for stocks that aren't performing or continue to decline. So we're going to now go over to the US small caps, and we'll do the Aussie small ords, emerging companies, all the commodities, what's going on in gold and silver. Really interesting stuff to talk about with that. But of course, that wraps up the free section. If you're not a strategy session member, there's a link below. Click that. Come on in. Doesn't cost you very much. And look, we go through lots of interesting stuff. The stuff on silver last week was probably worth the price of coming in, which is like a cup of coffee. So think about doing that. All right, so let's go over to the Russell. We'll start with the US small caps.